Here's a summary of the Walt Disney Company's Q2 2025 earnings call, focusing on key financial metrics, management commentary, and future outlook. Company: The Walt Disney Company DIS, quarter, fiscal year 2025, second quarter, 2025 Q2, overall sentiment. The company reported a strong second quarter, with management expressing optimism for the remainder of the fiscal year, driven by solid performance in its experiences segment and continued growth in entertainment. Key financial metrics and performance. Adjusted EPS, up 20% year-over-year, marking a solid first half of fiscal 2025. Experiences segment delivered strong results, with outstanding performance from domestic businesses. Returns on invested capital in this segment are at all-time highs. Domestic parks margins were up 110 basis points in the quarter. This improvement was attributed to a combination of factors across the parks and experiences side, not solely the impact of the cruise business. ESPN primetime audience, 18 to 49 demo up 32% year-over-year, making it ESPN's most watched Q2 in primetime ever. Advertising revenue, live sports increased by over 20% for the quarter. Advertising revenue, overall projected to be consistent with last year's rate of 3%, but now anticipated to exceed initial expectations. Disney Plus advertising. While demand remains strong, there are some challenges noted due to increased competition in the direct-to-consumer market. Highlights. Abu Dhabi theme park announcement. Disney announced an agreement to bring a new Disney theme park to Abu Dhabi through a partnership with the Miral Group. Disney will handle design, IP licensing, and operational expertise, while Miral will provide capital and construction. This marks the 7th Disney theme park globally, and is expected to serve millions in the Middle East and Africa, India, Asia, and Europe. Strong experiences segment performance. The company highlighted all-time high returns on invested capital within its experiences businesses, fueled by strong domestic performance and robust bookings for Walt Disney World for both Q3 and Q4. Exciting theatrical slate. Management expressed significant confidence in the upcoming film slate, including Thunderbolts, currently #1 globally and best-reviewed Marvel film in years. Lilo and Stitch, live action. Elio, Fantastic Four, First Steps, Freaky Friday, Zootopia 2, and Avatar, Fire and Ash. They also noted strong future lineups for 2026. ESPN direct-to-consumer launch. The company is a few months away from launching its new ESPN direct-to-consumer product, with pricing and timing details expected soon. This is seen as a key growth area. Streaming strategy advancements. Disney Plus integration with Hulu is positively impacting user experience, increasing engagement, and decreasing churn. Future plans include further integration, bundling with the upcoming ESPN direct-to-consumer offering, and enhanced technology for personalization and advertising. Investment in parks. Disney is investing over $30 billion in its Florida and California theme parks to enhance offerings and support the U.S. economy. Cruise expansion. The Disney Cruise Line business is performing well, with embedded Disney IP and high guest ratings, serving as a growth driver as more ships are deployed. Lowlights. Softness in China. The Chinese consumer market is facing challenges, leading to per capita spending not being as high as desired, although overall attendance remains good. Direct-to-consumer advertising competition. While demand is strong, increased competition in the DTC market presents some challenges for advertising within these platforms. Management's forecasts and future outlook. Full-year EPS guidance. The company updated its full-year adjusted EPS guidance to $5.75, an increase from the previously stated $5.30. Long-term guidance. The 3-year guidance for double-digit earnings growth in fiscal years 2026 and 2027 remains intact, despite the higher EPS base for 2025. Experiences segment growth. While full-year growth guidance for the Experiences segment was not changed, management is optimistic, seeing bookings for Walt Disney World up 4% for Q3 and 7% for Q4. They expect to be at the higher end of their 6 to 8% growth guidance for the Experiences business for FY25. Specific guidance for FY26 was not provided, but the long-term growth rate guidance remains intact. International expansion. While there are no immediate plans for an 8th global theme park location, Disney is focused on expanding its existing parks and investing in its cruise line business to reach more consumers worldwide. Significant risk factors. As stated in the cautionary statement, risks and uncertainties include, but are not limited to, economic or industry conditions, competition, execution risks, the market for advertising, future financial performance, and legal and regulatory developments. Most important statements from management. Bob Iger, CO. We had a very strong Q2 with adjusted EPS up 20% from the prior year, rounding out a solid first half of fiscal 2025. Our Experiences segment delivered strong results this quarter, driven by the outstanding performance from our domestic businesses. Investments in this segment have delivered impressive returns on invested capital, with returns from our Experiences businesses at all-time highs. Looking ahead to next year, we'll have Avengers, Mandalorian, Toy Story, and Moana in live action. We have a lineup for the next year and a half that I believe is as strong as any I've seen since 2019, which I considered our best year. It's truly robust. We understand that in our enthusiasm to enhance our streaming platform with more content, we relied heavily on all our creative teams, including Marvel, leading to increased production. However, we've recognized that more content doesn't always mean better quality. We've realized that we may have lost some focus by producing too much. By consolidating our efforts and allowing Marvel to concentrate more on their films, we expect an improvement in quality. Regarding Abu Dhabi. Among all possible locations, Abu Dhabi stood out as the best choice. Our agreement came together swiftly because we were convinced, especially after collaborating with our partners, that this was the right decision. Hugh Johnston, CFO. The long-term guide remains intact. What we announced before, no change to that. Referring to double-digit EPS growth in 26 and 27. In terms of the margins on the parks business, that's a combination of all of the businesses. So we had certainly seen margin accretion in the parks and experiences side. As well, not just the impact of cruise. The advertising market is currently very healthy for us. Live sports are performing exceptionally well, as reflected in ESPN's numbers, where advertising revenue for the quarter increased by over 20%. Overall, at the start of the year, we projected our advertising growth to be consistent with last year's rate of 3%. We now anticipate that it will exceed our initial expectations. Regarding streaming leverage, the answer is both. We can certainly do it on the G&A side, and especially as we start to add more to the product. We certainly expect to get operating leverage out of marketing over time.